Hi, everyone. Welcome to Web3 Founders Real Talk. My name is Blair. I'm the brand director of Main Ventures. So today I'm here with Michael, head of marketing of TrueFi, to share some actionable tips and amazing insights about Web3 entrepreneurships. Also, there are going to be some new and fresh updates about the product as well. So welcome, Michael.
Thank you so much, Blair. Really good to be here.
So let's just go ahead and start with a brief introduction about you and TrueFi.
Yeah, sure. So my name is Michael. I've been in Web3 since before it was called Web3. I got in about 20 originally starting up a marketing agency called Truth Cartel in the Bay Area to do a bunch of go-to-market for companies that were pretty early in the DeFi space, as well as in sort of the layer one. So companies like Trust Token, now Archblock and TrueFi, which we'll talk about today, but also folks like Compound, Algorand, Republic. So I've been around the block for many years in that space. Before then, worked in media and ran my own startups, but now firmly in crypto. Got my hands dirty as a marketer. I'm going to probably do that the rest of my career, and very happily leading the marketing efforts at TrueFi. To get into what TrueFi does, we are DeFi's first unsecured lending protocol. Now we like to think of ourselves as more of a credit protocol. What that means is we make fairly sizable loans, largely to institutions. We use a sort of a delegated underwriting process, which uses portfolio managers or the DAO itself to assess the risk and return of incoming borrowers or investment opportunities. Once those get approved, you as a lender could come in and invest in anything from, say, crypto market makers like Alameda, which is not just a user and borrower, but also an investor in TrueFi, all the way down to real world opportunities like investing in Texas or emerging market opportunities through our friends at Chorus Finance in Latin America and Asia, and even stuff like fintechs in Latin America with AI in one of our sort of fintech portfolios. So the way to think about TrueFi is we're an infrastructure layer for global lending, but especially credit, which is this sort of $8 trillion industry.
Definitely.
And so far we're about $2 billion in, no defaults declared, which is awesome and rare, frankly. And about 7,000 plus token holders, and really growing into I think hopefully the underpinning of global finance in the future.
Wow, very impressive. Thank you for sharing such informative information with us. So, Michael, let's just dive into the topic of conversation today. So, TrueFi was launched in November 2020 as DeFi's first and leading credit-based lending protocol, and the project has been progressing really well. So, we would like to know what inspired your team to develop the project in the first place.
Yeah, it's a good question. And to answer, we need to go back to like 2020 and even early DeFi. One of the big promises of early DeFi was that it would make the movement of capital more effective, right? Because it would lower fees, it would increase transparency, it would remove middlemen. And these are all fantastic aspirations. Anonymity is great, privacy is great. And for the retail user, for the individual, it's fantastic. Unfortunately, when you compare it to the world of credit, if you're going to borrow against your name versus against, say, your crypto holdings, collateralized borrowing, or you want to get like a mortgage loan or a car loan, which are all sort of backed by the underlying asset. If you want to borrow against your reputation, crypto had not had a really strong way to do that because they did not have a way to assess your riskiness or creditworthiness to your identity, did not have a way to do collections in a way that could interact with on-chain, defaults. And so this is a big, crazy, hairy problem. And until you figure out how to give credit, just loans without collateral, it's not really a big improvement on the effectiveness of capital moving back and forth. The biggest thing you're doing up is locking up capital. So even if you're saving a few bips on the transfer of funds, you're not really freeing up capital to move more freely. So to take you back to Trust Token's days now, Archblock, it's the name of the company now, we started a stablecoin back in 2017, TUSD, which is, I think by the time of this recording, somewhere in the $1+ billion and soon to be, I think about to cross the $2 billion range market cap stablecoin in the top 5 there. And we learned a lot about compliance. We learned a lot about global operations. We learned a lot about what institutions want in that era, and we built a strong team to do it. And so as we thought about what's going to be the next act for this company, we looked to our strong base as a company with strong legal expertise and compliance expertise, but we also looked to what the market needed, and it really needed this capital efficiency provided by credit. And because we were running a stablecoin business, we were on the edge of DeFi. Stablecoin is just a big Lego for all things DeFi, right? So we thought we would take a swing at uncollateralized lending, is this sort of golden goose, this sacred cow, you might say, of DeFi, this thing that's really hard to do. If you do it well, it's $8 trillion industry. And so far, so good. We've been operational for almost 2 years now. We did our first ever loan to Alameda Research, pretty popular market maker. We've done about $1.7 billion in loans since then. Collected about $1.3 billion in repayments. Again, no declared defaults, but we've had some really good restructuring and refinancing conversations. So, the credit crunch has affected everybody. We've decentralized a great deal. So we have a DAO. It's very hands-on now, and it's independent of Trust Token / Archblock these days with a foundation of its own. The token listed on pretty much every major exchange, community of tens of thousands. So very excited about that. And obviously even caught the attention of folks such as yourself over at Mint Ventures, which did a really great report on us recently that I really enjoyed. So you could say we've been, really moving and grooving on this. But at the end of the day, the big thing we want to do is to move global lending on chain. And a few $1 billion in crypto, we're really looking at we were looking to become the first $1 trillion protocol. And if you really want to do that, you really have to go to institutions, and you really have to move on chain. So we're just in the early stages of that, but it's very, very promising. Very ahead of us.
Yes, definitely. I would say it was really game-changing innovations to improve capital efficiency. So is there any challenges, or what kind of challenges did you encounter that you or your team have to overcome during the process?
Yeah, sure. I mean, we could probably put this in a few buckets, and the buckets all change as the project gets on. Building this thing, I'm not technical myself, but works closely with our engineering team. But building this thing is very, very complicated. And actually getting the technology right, it pushed us to the point where we actually acquired a development agency, a dev shop called ETHWorks, now under the TrueFi engineering umbrella. And we basically went from something like 2 smart contract engineers to 8 smart contract engineers to now 45 or so smart contract engineers, because building this stuff is very, very difficult. We're talking about literally rebuilding, lending infrastructure like Swift, used by, banks to move trillions of dollars around the world. So technical challenges are definitely there, but we've done, now 5 audits, no hacks, no vulnerabilities that have been critical. We've got bug bounties and stuff. So building it was definitely a big challenge, and I can't really speak to it as well as I could if I was technical, but that's a big one. The other one is, I think, figuring out the product market fit. During the era of, the bull market, people really liked lending to crypto market makers, like your Alamedas, Wintermutes, Nibios, what have you of the world. We were moving, vast sums of money, hundreds of millions of dollars a month, to these market makers, and providing really good yield, competitive from a risk-adjusted return perspective against the other things you could see on the TradFi markets or on the DeFi markets. But as the market has gotten to this sort of credit crunch, with Terra Luna collapse, with some of our centralized, you could say competitors, partners, whatever, having some real issues with their lending books, liquidity has flown out of the market, and there's a lot less capital to lend to these market makers, and the demand for diversity of portfolio opportunities, like real world lending and that kind of stuff, has increased. So we're also thinking about the product market fit. And the last thing I'll say is the regulatory environment has been really interesting. You can't really build in crypto in at least the DeFi market without some legal grounding and the journey to figure out how to build this thing compliantly. So, for example, how do we treat tradable like loan tokens? How do we manage the sort of controls over tradable debt? How do we allow that? How do we get liquidity without becoming a security? Or how do we build our company as a DAO or some sort of structure so that we can continue to operate indefinitely? How do we create master lending agreements that are enforceable and transparent and effective, while also managing to build an organization that's capable of pursuing collections in case of a default? These are all these hard questions that, if we didn't have an in-house legal team, which we do, we're very, very proud of that. We've had them since day one at this company. Then I don't know how we would have done it. And it's a big question. So technical, regulatory, and business/product questions all abound. And hey, we're still working through all of them. And that's kind of the beauty of this industry. We're still on the bleeding edge.
Yeah, that sounds pretty cool. I mean, it was definitely a really hard, like steep learning curve for everyone since, in early startup, everyone has to be really versatile, well-rounded player. So
Right.
yeah, that's so glad you guys make it.
Yeah, it's a classic saying, like everyone is both the CEO and the janitor at like some of these early
Yeah.
stage startups. And there's a lot of things to be janitor about, especially when you have the community managed too. There's a lot of like needs that come from like the bottom up. So yeah, it's been a journey. It's still a journey. Got a long ways to go. I think we're in like the era of server racks from like a Silicon Valley perspective. Like like Silicon Valley is alive and well at this point, but we're still in the era of building infrastructure. If you want to build a startup, you have to like buy your own servers and you have to build racks and you have to slide them in and have an IT professional kind of manage that stuff. So we're not in the era of cloud yet in DeFi. And so we're over here getting our hands dirty in the trenches, building the infrastructure, which is a great time to be early, but it's hard work. And it's especially because of the regulatory overhang.
Yeah, it's gonna be a lot of work. So since Web3 as a new business paradigm, so what differences you have spotted in your process? Like you just mentioned that product market fit, like how to capture the accurate market insights to develop something like game-changing, sustainable products that people they really need, since there have been a lot of ideas, innovations, hypes going around that people they could spend months of their time and resources developing something they believe is a perfect fit, but end up with really little traction or adoptions. Is there any your like advice or recommendations to those people that they may work on their own project?
Yeah, sure. I think one of the hardest thing about the space is it's actually really easy to get distracted by shiny objects and opportunities. Building the next algorithmic stablecoin or like high yield lending platform based on high inflation.
Yeah.
They're or like doing another NFT drop. These are all fine ideas, and I'm sure there's some really beautiful innovation to be found on the bleeding edge of them, for sure. I don't discount that. But if you really want to build a sustainable business, then it really helps to not think about crypto as this wild west per se, to think about it as a particular technology, the same way that your mobile phone was technology that allowed Uber to exist, where previously you would have to call a cab and give them an address. The mobile technology allowed you to have GPS coordinates with you and to do it all from your phone on site. The same way to think about that is like, what is the blockchain technology enabling that would disrupt an existing business? And I don't think that a lot of founders in the crypto space necessarily start with the idea of disrupting an existing business or an existing industry. They have a bright idea of a fun sort of, philosophical or academic or mathematical model, or maybe an art project that they think is going to be cool. But I think, and unfortunately, what tends to happen is it's a solution looking for a problem. And what we really want to do in the crypto space, like any startup founder should be doing this, is you want to be actually looking for a problem and you have a solution. And so when we started TrueFi, we had a few problems. One of the problems was that folks were not getting the max they could be in DeFi. Another problem is that in TradFi, they were paying vast sums of money and having operational inefficiencies for moving money around. And that lenders were not getting really good opportunities because, say, it wouldn't make sense to appeal to the small fry who wants to put in $100,000 or $1,000 into something when it costs so much money to proposition them to offer their money into in the first place. So there are these like market inefficiencies that we saw that are actually like, hey, we're disrupting an existing business. And if we rebuild this on blockchain, there's a path to profitability. There's an established business model that we can make more efficient and we can make more, accessible to people. And that's a business. That's not just a crypto idea. We're like changing the paradigm, kind of, new moonshot prospect, which I'm all for, and I like the experiments. But this is a nitty-gritty business. And, you eventually have to start working with Wall Street people and regulators and what have you to do it right. It's a grind, which is why I think some people didn't go after it. But it's $8 trillion opportunity, The market's there, the business models are there. And, if you can start with trying to modernize an existing business using the technology of blockchain and crypto, then I think you're on the right track. If you're just going to do sort of pie in the sky moonshot projects, then more best of luck to you and hope you find something innovative. But the risk reward there is not as high, I think, in actually trying to modernize an industry like we're trying to do here.
Yeah, definitely. So 100% agree with you. Like startup teams, they probably will need to, validate that the problem they're attempting to solve is real, and their like proposed solutions would prove effective in like solving the problem. So I think that would be the key to how to, make your project not only survive but also thrive in the future. Well, like good product built by, good team. So the next question is about like how to sustain a stable but efficient team, since there are some, Web3 companies that are suffering from really high turnover rate.
Yeah, it's a good question. And there's not a great answer to this question, I don't think. Retaining talent has always been like a big industry challenge in sort of like bleeding edge fields, because there's always something new and shiny to work on, and a lot of folks with high risk appetites like will just we could talk a little bit about how do you design token incentives and that kind of stuff to create kind of these like not golden handcuffs, but incentive alignment. I think that's actually a key part to like give people that work with you early days enough tokens to make them long-term aligned. I think that's the biggest thing crypto has going for it. But besides, hey, build a great culture of a place to work at, build a product people actually give, a damn about, so that it feels like you're working on something useful. Next hype cycle. And, I think it's also, it can't be overstated to just give people a lot of agency and put them in a place to succeed, which is to every company and find the right people. But if there's any, it's that these tokens do play a larger role in retention because they have this sort of long-term value alignment, not just alignment in, hey, you're going to appreciate the stock value, but also these tokens are by nature participatory. You can stake them, vote with them, pursue governance actions. And so it makes every person in the company, if you're trying to retain talent, effectively wear two hats. They wear the hat of an employee and they do their day job. And then when they leave the day job, they put on the hat of, being a token holder. And as a token holder, they actually have, maybe a little extra incentive to participate in the forums and the Discord and to make proposals and to think about tokenomics and design, because their long-term value is tied to the success of this project in a way that is unique to crypto. So I like that component of retention that crypto offers. But besides that, it's, blocking and tackling a lot of the same old stuff from Web 1, Web 2, build a great company culture and let people do their best work.
Yeah, so definitely token is something specific, special that people, they would get engaged in Web3 world. So since Web3 has been a really like a buzzword, I would say, so we can see there are like more people that are just interested in building their own career in this space. So what advice would you give to someone trying to become an entrepreneur or even, go get a simple job?
Yeah, sure. Well, their crypto, despite, whatever bear market we might be in now or whatever winter might be ahead, I think it's still a very popular place to work. There's a lot of really good opportunity and there's a lot that needs to get built. So I think we're lucky in that regard. When it comes to the skill sets I see most needed in crypto, I think that we've built a pretty good technical talent base. There's a lot of engineers who've learned to, write beautiful smart contracts. A lot of front-end people who are getting involved now and building better UIs in crypto than I've seen before. I think that we're probably a little underserved from more of the business side of things. And so I'm biased as a marketer myself, but I think we need a lot more help in getting the message of crypto out there, not just what it is and why it's useful, but how to use it and what appeal it offers to the common person. And I think we also probably could use a little bit more of a developed hiring pool in more of our BD and business development kind of sales roles in two ways. One, particularly to pursue integrations from DeFi protocols and other crypto sort of products and sort of services into things that have beautiful front ends such that users don't have to think about crypto. Like that's one of the big pathways to adoption on the retail side. Integrating your protocol, integrating your service into the front end of something that's already beautiful and has high user bases, maybe a Robinhood or Coinbase or what have you. Like those integrations would really change the game for a DeFi protocol. And that's a BD play, a sales play. And then on the other side of sort of the BD side is I don't think we've necessarily gotten as much traction in getting the institutions to play ball as we could. The family offices, the banks, you think about the amount of money sloshing around in TradFi, and not all of it is necessarily most optimized for value in terms of going to the right place or reaching the most amount of people as prospective investors, or say most transparent. Blockchain does actually help with a lot of this stuff. And I don't think we've made the best possible case to the institutional side there. And if any of these roles sound interesting to you, then I usually think of it as a two-pronged approach. First of all, learn a lot. That really does look like, it's doing your own education. There's a lot of great, amazing resources that weren't around when I got started. I think of the Bankless podcast as well as their newsletter. Mid Ventures, you guys have some really good content too. And there's the research reports if you are interested in particular projects. I'm really a big fan of the Financenomics YouTube channel. I might be, mispronouncing that. But they've got really good explainers on some of the crypto concepts. Andreessen Horowitz, A16Z, has a lot of really great, what they call crypto canon, the must reads for the era. These are all amazing resources. They're all out there. People have put a lot of work into getting them together. And the first thing I would do is educate yourself about the whole thing in the industry. And then the other thing is to get your hands dirty. And there's levels to this game. Go set up a MetaMask and try some DeFi protocols. Fund it with a little bit of ETH, a little bit of USDC, and try some DeFi protocols. See how you like it and understand what the problems are and see where putting your money makes sense. You're not really going to be taken seriously as a candidate if you don't have a MetaMask wallet, if you're trying to apply for a crypto job.
For sure. Yeah.
Right. And then that keeps going. Maybe you start participating in a DAO and making useful contributions. Maybe you make proposals to the DAO to actually fund your role. Maybe you eventually put an offer in to gain employment at either a centralized or decentralized company in some way, whether through a proposal or a formal job offsite, like offering. There's an escalatory process there, but like getting in, and like enter any industry, like you're entering VC for the first time, you're entering product management for the first time, entering marketing for the first time. Got to learn a lot, got to get into the arena, got to have a few battles. And then when you're feeling pretty brave, you can take on the champion, and champion being getting a job in the space. It's not so different from any other field. And I think it's better suited to new entrants now than ever.
Wow. That's some really actionable tips. And I believe that, especially like Web3 startups actually face a more competitive and fast-paced environment than Web2, Web1. And Michael just shared some insights in terms of how to deal with challenges, how to grow your business, how to keep your team motivated, and how to get yourself hands dirty in Web3 industry. So next, let's just check some progresses like TrueFi has accomplished. So you just mentioned in the beginning that within the first year alone, like TrueFi hit $1 billion in lending without any defaults. So today it still has not experienced a default. And also you guys have successfully survived from previous CeFi, DeFi situation.
Situation indeed. Right.
Yeah, that's definitely a situation. And what kind of risk management strategy have you been implementing? And is there any experience or advice you would share with other practitioners? Because definitely they would need some advice.
Yeah, sure. It's a good question, and it's a difficult question, I will say,
Mm-hmm.
because it requires such a level of expertise that isn't really found in crypto broadly speaking.
Mm-hmm.
The idea of having a credit risk committee, but also we have a compliance team that does a lot of the background checks on prospective borrowers and what have you. Some lending pools actually require you to KYC so that the borrower can confirm that you are, say, a non-US person, so they avoid the regulatory hurdles there, or that you're not you're not originating from a sanctioned
Yeah.
country. These are all
Mm-hmm.
these like hard, tricky questions.
Mm-hmm.
What I'm going to try to do is I'm going to try to offer a very broad, like something like the transferable knowledge here that I actually offer is I want to offer you a perspective on how to think about risk management in credit. And the way that I've seen it is there's actually kind of three models to how to do underwriting
Mm-hmm.
of incoming, risk-adjusted return financial opportunities, right? You've got like a borrower coming in, they're going to say they're going to offer you 8%. And you're like, okay, cool, but at what risk level, right? And so what do you do to assess that? And I'm going to speak in pretty broad terms because I'm not an expert on this space. And I have to admit that it really does take an expert to talk about this in an educated fashion. But I can at least offer the perspective of here are the ways you can solve this problem. So, speaking to the situation that some of the folks in this particular tier are in, there's the
Mm-hmm.
centralized underwriter model, which is popular in TradFi and to some degree popular in crypto. We can think of folks ranging from I'm going to name some unfortunate names here, whether they're Celsius or Voyager to Galaxy, others in this space. The centralized model of underwriting, which is to say you have an in-house credit committee and you might think of it as kind of a private loan book that you manage. This has been very popular in the first version of DeFi. DeFi, I use the term loosely. But because the currency led to really risky betting in this space, this what I would call centralized underwriting model in crypto has lost a lot of credibility. It's still obviously very popular in traditional finance for non-crypto assets, right? That's where most of the industry is, with banks doing underwriting. But the centralized underwriting model in crypto, I think, has gotten really shaky, and there's a big demand for one of these two other models I'm about to explain that are a lot more transparent and a lot more permissive in terms of the information exchange. The model that I found in the beginning was a true decentralized credit rating model. We allowed you might say, wisdom of the crowd to dictate which new borrower would be allowed to come on and which loan would be approved. We had a steering committee of sorts, a credit committee that at that time was in-house at Trust Token that would give advice and would play a sort of a paternalistic role in this. But by and large, you had true token holders saying, hey, this borrower came in, put a forum post together, stated their thesis, stated their goals about how much they wanted to borrow, what cost, how they wanted to use the capital. They said yes or no to them. Most people got no's and some got yeses. And then, over time, that model proved to be reasonably effective to get things off the ground. But unfortunately, it doesn't scale very well because it's a very time-consuming process to have the community engage with every possible loan and every possible borrower.
For sure.
And the community doesn't exactly have expertise, not just on the risk-adjusted return of a particular opportunity, but also on the given market of a particular borrower's interest. So, like, does the community of however many thousand people who some of them just like our Twitter or like their NFT drop, are they exactly credit experts on the real estate market? I doubt it. And so I can't, in good confidence, see the fully decentralized like wisdom of the crowd model as actually ultimately scalable. And so we've moved to in the present these days is what we call a delegated underwriting model, where the community does not designate the creditworthiness of a given borrower or a given loan, but they designate the expertise. They validate the expertise of a particular underwriter. And the way to think about that is, if you, for example, manage a portfolio of real estate and you desire to get more capital so that you can make other capital investments in real estate, well, you'd be the perfect woman to run it. And if you come to the TrueFi forum and say, here's how I plan to use funds appropriated to me, here's the kind of return I can offer you as an investor in my fund, here's how my fund has performed in the last 2 years, we would say, but a portfolio manager. And we would designate you as the person responsible for sourcing new opportunities with borrowers, collecting on those opportunities if there should be any problems, designing the capital structure for how much money should go out, how much money should come back in, when and what rate, setting the fees in your portfolio. And this delegated model removes the risk on TrueFi as a protocol, as a centralized underwriter or as a decentralized underwriter. And instead puts the underwriting in the hands of a true expert who feels very, very responsible for the success of their portfolio and who has the benefit for their success of having capital access that they wouldn't have otherwise. So I think we finally found the right medium of like community engagement, like a little bit of centralized paternalistic oversight, and this sort of primary focus on this delegated model where we put, expert decisions to be made in the hands of experts. And so, if I'm going to give you a broad answer to this, I'm going to say, leave this question to the experts. This is a very technical field, even probably more so technical than some of the smart contracts writing. Credit is, a really, sophisticated problem, and it requires sophisticated individuals and a sophisticated design. And we found the best design is to really, again, almost back to your hiring question, you put the right people in the job. And we think of portfolio managers as the right people, and we think of the, folks with expertise in a particular field as being the right people to run portfolios in that field.
Yes, that's a lot of information to process, but apparently, apparently there are tons of risk could occur, like counterparty risk, regulatory risk. But I think the point would be having a proactive risk assessment and management are pretty critical to the business, and it will impact the business sustainability very much, since we have seen a lot of lessons already happen. And probably there's some project they can go really high, but they can also fall apart in one day. So
and we've seen that too, unfortunately, even recently.
So but other than that, I guess the business skill is also the key to keep the project alive. So recently we've seen that TrueFi updated some product, and also we can see some new business line. For example, like there's one single borrower portfolios. So can you elaborate more on this new products, or are you guys planning to expand this new market with your new product?
Yeah, sure. So let's talk about some of the TrueFi products. We've, the idea of like, how do you market your products is actually not an easy question. And so I will admit freely that we're still figuring out the right way to share with people all the things you can do on TrueFi, especially as the set of things you can do grows. So the way I would actually have you invite you to think about TrueFi is, when you come to TrueFi, as a person wanting to access capital, which is what a single borrower pool user might want to do, is you actually get asked a few questions. Number one is, who's going to manage this portfolio that you want to spin up? Is it going to be the DAO? Is it going to be this kind of permissionless DAO pool that will allocate the funds to crypto market makers or other portfolios, right? That's what our biggest pools are today. They're these DAO managed pools that make all kinds of loans to, frankly, all kinds of entities. Do you want to manage the pool as your own borrower? Meaning you want to basically set the terms, and people who come in are only going to borrow to you, or only going to lend to you. And not a lot of people can get away with that. Not a lot of people have folks lining up around the block to lend to them. But the most in-demand borrowers do. And one example for us is Alameda. Alameda, a lot of folks want to give Alameda money. They see them as very smart capital allocators with a pretty good risk-adjusted return. And Alameda, being a smart capital allocator, gets to set rates that are a little more competitive than their rivals. They're not going to offer you as much return on your capital because they believe they can get that money at a better price. So these single borrower pools, I'll get into in just a moment. The last version of this that we also have is, like I talked about, these portfolio managers. As a portfolio manager, you're going to spin up a fund with a whole strategy, and you're going to tell us what the strategy is, and we'll let you know if, the community will let you know effectively if this is the right place for you to do that. So you make the decision. You make a decision about, how you want to allocate the capital and how many risk tranches you want to do. And then effectively you get spit out this product. The single borrower pool product effectively allows you to set up a pool of capital from which you can take out loans and offer a particular return. But the borrower is also the manager. And it allows individuals like you and me, provided we are, compliantly able to do that within our jurisdiction and we pass KYC, if that's what the borrower requests, to lend directly at Alameda. And frankly, there's not a lot of way for retail users to be able to do that.
Yeah.
So these single borrower pools are effectively a way for you to get privileged lender access to some of the best companies in the crypto space and beyond, who are saying, hey, I want to borrow. I'm willing to give these competitive terms. And because it's so credit worthy, I'm going to be a little more selective with whom I can accept money from, at what rate I will be willing to pay. But hey, if this is for you, then you can go ahead and participate in this pool. And so that's a single borrower pool.
Wow, that's really impressive. I mean, it sounds TrueFi has continues to expand its footprints to become, I would say, the most capital effective liquidity source
We
for
like to think
crypto
so.
native companies. Yeah.
And hopefully, also, it's interesting too, if I may, also hopefully not crypto native companies only, right? So of course, we're in that market, and it's a lot easier to work with like people who know this industry than not. But you're not going to get to become $1 trillion company by working with crypto alone. Not in this era. So I think it's important to get capital access to real world borrowers. And it's interesting because like you think about in America or Canada where you are, capital access there is pretty competitive. It's a pretty efficient market. But capital access in Latin America for a growing fintech business, or in Southeast Asia for an up and coming, transport company trying to build a fleet of tuk-tuks, which, our folks at Chorus Finance do as a sort of portfolio manager. These are hard problems to finance in that country, where the cost of capital is very high, where the terms for borrowing are very onerous, and yet the market is very vibrant and has high demand for what the services are being offered. And so if we can be as effective a capital borrower to not just the crypto markets, but say emerging markets, or to mortgages in Texas, which we're doing with our friends at Teller and USDC Homes, then we're becoming a really interesting player in global finance. It's the ultimate goal. We're going to fine tune this technology with crypto, but crypto is the bootloader. It's how we're bootstrapping this thing, and we're ready for. I think we're ready for.
And also, you may answer my next question partially, because as far as we know, because I was going to ask, like, TrueFi, borrowers mainly use the money to do arbitrage and market making, but with the whole crypto market cooling down, and the profit margin for the borrowers has shrunk a lot, and I would say the demand side is downsizing. So how to pick up more business in the bear market for TrueFi? But yeah, you answered that. Probably that's probably going to be a good timing to expand to non-crypto native companies.
Yes.
Yeah.
And it's actually it's kind of like a 3-part answer in my opinion, maybe 4. Like the first thing I'll say is like, don't get us wrong, crypto market makers and borrowers are very much looking for cash. They would love some cash right now. In fact, they're paying very high rates for it because they love volatility. They love these choppy waters. They love buying things cheap. They're actually trying to borrow as much capital as they can. Unfortunately, there isn't much of it around because they want to get ETH at a cheap price. They want to get altcoins at a cheap price. They like the up and down ping pong market that we're in right now, because all of this is opportunities to make spread and return on volatility. So demand for borrowers is there. Liquidity, unfortunately, is not there. So let's talk about how we're going to find liquidity. One of the opportunities that we're thinking about is sourcing more institutional capital. We have our sort of former parent company, TrueFi's parent company, once called Trust Token, which was famous for launching TUSD back in the day. Now it's called Archblock. Archblock is focused directly on one thing: sourcing that institutional capital, making it as easy as possible for institutional capital to flow in. The billions of dollars locked up in family funds looking for a really good yield that they're not really going to find in, let's say, the bond or stock market in a sort of overheated inflationary economy. We have a very dedicated team to do that. We're having conversation with bulge bracket banks, with family offices. That money is really interested. It doesn't really know how to go in yet, and it'll be a little while before it does, but we think we're going to be one of the best places to put that money to work. So institutional capital, I think, is one place to source liquidity. And we have a team dedicated to it. The other thing that is really interesting is you look at the treasuries of DAOs. There's a number of them. We are in deep conversations with MakerDAO, who wants to do real world assets backed, real asset allotments, at the very least, allocations there. We got approved for $100 million allocation through MakerDAO already. And the same with Frex. Frex also wants to put money to real world assets, and we're one of the good places to do it. Deep conversations there, but not just there. We've got companies like Wonderland with GuildFi. These are all companies that, they're just managing their treasuries, but they decided that they wanted to put their treasuries to work in TrueFi, where we're doing corporate debt and your crypto market maker lending and also real world lending. And so you're starting to see more of this DAO treasury adoption. I think we have a really good offering to make to DAOs with large treasuries that are comparable to family offices. These are just a big family of all token holders. So we're seeing that as a good opportunity for us. And that's what the TrueFi BD team is focused on. TrueFi is a dedicated team of trying to source that kind of capital into TrueFi. And I guess the final answer in terms of trying to solve this problem is by adding a lot of new real world opportunities on, very, very diversified from the kinds of things you would see in other places in DeFi. And by making those opportunities composable with other DeFi protocols. So for example, by the end of this quarter, with our Q4 update, we're doing a lot of standardization of our vaults and our loans themselves to be compatible with a new DeFi standard of vaults. We expect that you'll be able to add, say, to a Yearn vault, right? Or another vault in DeFi that is producing some sort of yield. You'll be able to add corporate debt from TrueFi, just as adding, LP pair or a Lido allocation as a yield bearing addition to the composable elements of your vault. So effectively, that's to say we hope to attract some of the DeFi cap liquidity by offering something not found in DeFi elsewhere, real world lending, and we hope that we source that lending by offering the most composable way to add some diversification to your vault, to your portfolio, in the form of these standardized vaults, making real world loans. So those are the kind of 4 ways of treating liquidity: institutional, DAO, composable sort of DeFi loans. And I will say borrowers are still very much in demand for capital, and the rates are high. So there's still some demand, some liquidity there.
Wow, that sounds like a really solid plan. Looking forward to see more potential, synergy with other DeFi protocols and with other kind of, looking forward to see like more innovations happening on TrueFi. So here's my last question, and it may be a little bit tricky because, there are more like similar projects emerging, and how do you plan to keep your first mover advantage? Because we can tell like first movers always share the biggest pie in the crypto space. So how to keep your first mover advantage since you're being
super good question. So we've had some very strong competitors from pretty early on, and we like that. It makes us move faster, and we definitely learn a lot from them. One of the things that we've done since the early days against direct competitors is we've focused a lot on the risk return of our incentives. So some of our competitors, our direct competitors, are actually shelling out a lot of incentives to get the kind of capital, to attract the kind of capital that they have in the books. We're being very smart. We're spitting out about 50% or less of the incentives that our competitors do in order to attract capital, and I think that's good for the long-term health of the token. So smart risk return on incentives. The other way, we've been, again, very, very selective risk. We have, again, a very, very involved credit committee comprised of both in-house and DAO people. And we've taken on lending opportunities that were, as the market has proven out, to have been pretty good choices. We've had no defaults, and not all our competitors, both centralized, and we've named some names there. There's some people in real distress. And our decentralized competitors have not had such luck. And they've had some real issues with their lending books. And so I think by virtue of being able to show a really strong risk management history, we're probably going to be able to attract more capital there. Now, longer term, the best thing that we can possibly do is build the best product, and then to get that product out in front of as many people as possible. And so I think if I'm going to term where we live, there are other competitors that we look to as inspiration for us and kind of like fire in our butt in terms of the infrastructure they've built. They've been around longer than us even, but they haven't gotten as much traction. And so that's where it comes to building a great product. We really want to build what I call feature parity, meaning the same suite of products you would find in traditional finance, except on-chain. And so that really looks like getting our engineering teams to look at what's happening in the lending markets and really helping build those kinds of features. So I'll give you two examples that we're building now that are really designed to attract more capital, because they really they are built for two different audiences that want to use this stuff. The first one I already told you about, standardized vaults, pose our lending book into other vaults around DeFi. So suddenly DeFi gets more exposure to corporate debt, which you never had before. And the other side, the institutional side, is we're doing two sort of big updates. One is around tranching, which will effectively look at a particular, say, to let's take again, maybe Alameda in this case, and select your level of risk and return. And at the lowest level of risk, you're also going to enjoy the least return comparative to the other tranches, but you're also only going to be affected by liquidations if the two tranches ahead of you, two pools ahead of you default, or rather are liquidated first. So you can then choose as an institutional investor to take the least risky bet in a particular pool that you're interested in. And also during this time, we've also instituted what's called a capital formation period, which means that as an institutional investor, you could say, I only want to deploy my capital if there is double the amount of money in the junior tranche, the more risky tranche, as I've put in. So if I put in $1 million, I need $2 million in the junior, and the portfolio won't launch until that happens. And that portfolio won't be able to allocate capital to put capital to work. So these are all designed for institutional clients who have asked us for this direct thing. That means either MakerDAO or through banks and so on. So we're building for them. And here it's not just building these things, it's also messaging them and properly getting them in front of people. So I'm doing my very best to get these things described well and have a really good team behind us in terms of telling the TrueFi story and messaging the various products we have. But we also have the benefit of Archblock behind us, which is basically going door to door, bank to bank, family office, with a pitch deck in hand and conference speaking slots, trying to sell this up to the institutions. So I don't know of any other team that has this two-pronged approach, and that I guess you could say forked approach, where we both focus on product and messaging, and we focus both on the DeFi world and the institutional world. And we have experts in every corner of this to do it. So I'm very bullish on us long term, especially with tokenomics updates to come that will hopefully continue to attract the success that the protocol enjoys into the value of token. And so I think it's bright days ahead, and it's still early. It's so early. So I really invite folks who are interested in being on the cutting edge of something, and effectively DeFi truly and earnestly disrupting banking rails. To steal a quote from There Will Be Blood, a favorite movie of mine, is we're going to drink their milkshake. We're going to really just get underneath the skin of banks, hopefully, and make them see the innovation here and have them move on chain, and then hopefully become the world's first $1 trillion protocol in the process. And $2 billion in, but just watch.
Yeah, we'll see. That's definitely a very compelling story that, it's really great to see that TrueFi has very comprehensive tactics to improve capital efficiency, as always, to engage more business with proper risk management. Thank you for, thank you for being really informative and insightful, Michael. And I really appreciate your time, and looking forward to seeing more accomplishments and innovations happening on TrueFi. Also, I hope everyone could find something helpful from today's conversation in your own Web3 journey.